Hey everyone, it's Mike from Orderflows here, and welcome back to my channel. I'm glad you could join me for today's video. I'm going to dive deeper into, sort of a footprint chart versus a normal candlestick chart. And, sort of the reason why this video, the purpose behind this video is because, sort of a comment that came up a couple days ago from Kasun Chamara 749. I hope I got that name right. Kasun Chamara. Now I know he didn't mean any disrespect. I know he's a follower of mine, but I just found this a very important topic to discuss because he said he started out with another broken flow guy because of ICT. Yeah, as I said, I'm not butthurt or anything like that. But he says, show us your performance without footprint, range chart, or any kind of volume tools. ICT always shows his performance through naked charts. Can you do the same performance without volume tools? Yes, ICT never says volume tools are useless. Instead, it says they are good tools, but practice eyes for tracking institutional footprints through naked chart. I'm also using volume tools to prove myself how accurate is Michael Huddlestone's liquidity concept, and all the time I see his concepts are freaking good and working in any time frame in any instruments. And like I replied to Kasun, and I said I'm not heartbroken. There is some value in ICT stuff, right? There's many different ways to trade the markets. No one way is the best. Instead, what's best is for the individual traders, right? I prefer to look at volume to determine where there's really an imbalance. To each their own. And to Kasun's credit, he did come back and explain further, saying, no disrespect or anything. He does find a lot of value in what I teach, and yeah, and he gets it, right? And Kasun also understands the importance of volume, and this is important because there's so many different ways to trade out there, and really, what you got to do sometimes, is you got to take stuff from one method of trading and a different method of trading, and sort of fuse them together into a way that you can understand the market best. All right. And I'll be honest with you. Let me get this down. Let me get this out of the way. I can't look. I mean, I could look at a normal candlestick chart and trade this. I mean, there are certain patterns that I'm looking for on on candlesticks, right? I mean, this is, I got, to me, this would be a buy area right here. But to be honest, I find my edge comes through looking at the volume, right? At the footprint, where the value areas are, where there's point of controls that matter, where the imbalances come. And again, I'm not knocking ICT stuff. I just get a chuckle at it sometimes because, I see guys on Twitter saying, yeah, there was an imbalance here. I'm like, okay, how can you see that? Just by looking at, a bar like this, right? A fair value gap. Okay, yeah, I mean, I know that, and this is where it gets interesting, because if I were to look at, okay, so for example here, if we call this a fair value gap right here, 1947.20 to 46.50, when I got a big bar down like this, there are going to be imbalances in there, just by default. Let's see, what time this was 10:07. Yeah, you got one imbalance in here. Obviously, you got a fair value gap between this bar and this bar as well. But you see, yeah, there are imbalances. Anytime you're going to have a long stretched out bar in a market, this is gold. Generally you are going to have an imbalance in there, at least one. All right, but okay. So you sort of get the ideas. Now, again, at the end of the day, it comes down to what helps you as a trader really wrap your head around the market. Because, if I was just looking at a simple candlestick chart without volume, then at that point I'm looking at price patterns. Okay. But I know that for me, when I'm looking at price patterns and then I could add volume into the mix, I mean, actual volume, it just helps me out more. And there's nothing wrong with it. I lived in Singapore for about 10 years, and as an American going over there, I'm used to, you're sick, you go see the doctor, maybe you gotta, they'll do an x-ray on you and tell you what's wrong. My friends used to take me to this guy. He would just take your pulse and tell you what's wrong with you. He doesn't need an x-ray. So there's, and he would prescribe, the TCM, the traditional Chinese medicine for you. You need some of the, I don't say eye of newt or whatever, but you know, you got to eat these bugs, and you don't just eat them, but rather you make them into like a drink, and then you drink it, like the different herbal leaves and things like that. But what I'm saying is, you know, Western doctors have a way of looking at a patient, determining what's wrong with him. Or let me rephrase that, look at a patient, tell me what's going on with the patient's overall health. Whereas, you know, sort of the traditional Chinese medicine doctors will take your pulse, you know, and by taking your pulse, right, they're measuring your sort of blood flow and all that, and then they can tell you what's wrong with you. Okay. Now, you know, you have to, at the same time, you sort of got to believe what they're doing. You know, each doctor, you know, knows the right way, but that's not to discredit one or over the other, right? I mean, the Chinese doctor, he'll probably look at an x-ray, can't make anything of it. Fine. That doesn't mean that he's not a good doctor, all right? So there's many different ways to trade and approach the market. Now, you know, that being said, you know, you know, I have an indicator. I've never released, you know, people always ask me about a lot because they see in my charts here, there's a lot of indicators, right? And there's a lot of indicators I haven't released. Some of them, you know, just things that I've worked on off and on over the years. I've had my programmer make stuff because I was looking for certain things. But I actually have one here. It's called the bar gaps indicator. And, you know, let me just add it in here. But, you know, it's kind of loosely based off of fair value gaps. But what I've done is I've taken sort of that idea of, you know, sort of price moving, right? Because, yeah, I do understand the whole concept of ICT, fair value gaps. But when I start to add it together with order flow, right, add what I look at in the market into something like that, it, in my opinion, makes me a better trader in a way, makes me understand the markets more, right? It might be a little bit hard here to see the little arrows. Well, let me just make them a little bit bigger here. Because, you know, at the end of the day, right, there's, like I said, you know, I'm a big believer in this. There's no one right way to trade, right? And, you know, so you can see, even though, now this is where it gets interesting, you know, there's some fair value gaps, what I call bar gaps, right? Gaps taking place that I think are more tradable than others, right? So you can see like a zone here, you know, it didn't give a signal. The triangles areas where you're going to get long or short, right? That just, you know, now I've added in what I know about actual order flow volume that's taking place in the footprint that can, because like, for example, right, if I see a certain thing happening in the volume taking place, you know, in the footprint, yeah, it's going to give me a high percentage trade. And if I could wrap that around, you know, some sort of price action, because, you know, at the end of the day, really what the fair value gap is price action, right? It's a bar and you have a gap, you know, you have the big bar moving, you know, from the high of one bar to the low of the third bar. So bar 1, bar 2, bar 3. You know, and you're going to see areas where, you know, you know, like here's a gap that went down, right? But here's another gap that went down, didn't really work. So by adding the extra element of looking at volume, looking at the actual trading that's taking place between the aggressive buyers and the aggressive sellers, right? I could take a price action setup and make it into, you know, something that's more useful for me. Okay, because again, you're not going to just want to take every sort of fair value gap that you see taking place in the market. I mean, you could, all right, but then, you know, you're going to have winners and losers. You want, in my opinion, you know, you want to sort of take the best ones, right? I mean, that's what trading is all about, right? You want to take the higher percentage trades that are coming, right? I mean, there's euro currency, okay? So at the end of the day, you know, getting back to Kasun's comments, I can't show you performance without footprint chart, range charts, or any kind of volume tools, because that's something that I lean on. That's where I find my advantage in the market. Okay, you know, just think of it, you know, playing poker. Some guys can read tells great. Some guys can do the math in their head great. Doesn't mean one way is better than the other. Obviously, if you can read someone's tells as well as do the math in your head, that's going to make you a stronger player. So again, at the end of the day, you know, trading is about taking what is available, the information that's available to you, and using it to your advantage. Okay? Because at the end of the day, we all want to have an edge in the markets. Sometimes our edge comes from this place or that place, and you got to put it together. That's where you're going to succeed as a market. I've worked with guys. Right? There's a guy, I can't remember his name now, it's so long, at Commerzbank. He was like this prodigy kid where, you know, was a 22-year-old kid out of college. He made like 20, this was back in the 90s, right? Guy made like $20 million or something like that as a beginning trader at Commerzbank. You know, $20 million back in the 90s was a lot of money for a trader to make, especially a beginning trader. And he felt like he got screwed on his bonus and he left. But he was somebody, you know, I could talk to him. God, I really can't remember his name. But he can take macro information and sort of see where the market would be 6 months in the future. And it's something so tiny, a little piece of information, hoof and mouth disease in Essex County and in London or something like that, and say, okay, this is where I expect gilts to be off of that, you know. But whatever, he had his way of approaching the market. Like I said, there's no one right way of approaching the market. Really, what you got to do is you really got to blend stuff together sometimes, right? To make the market make sense to you. So again, you know, because shout out to you. I appreciate your comment. I know there's no disrespect. And I appreciate comments like that because it gets a dialogue going so traders can understand, because a lot of newer traders come into the market and they watch someone trade or they follow them on Facebook or Twitter. This is it. And, you know, and it's like, if you don't agree with it, they beat you down or, you know, call you a hater and stuff like that. But really what trading is, it's just making the market make sense to you, because everyone's got a different mindset. Everyone's got a different way to approach the market. All right. And it's about finding what works for you. So again, you know, if I was looking at a normal candlestick chart like this, yeah, there are patterns I can see that I'm always looking for, right, based off of price. But when I'm able to wrap it around with volume tools, to me, that just makes the market, you know, in my opinion, to me, make perfect sense so that I could trade it confidently. Because, you know, again, you want to be confident in your trading. You don't want to be sitting here, oh, you know, is this, is that? You want to be sure about what you're looking at and trading it. So anyway, guys, you know, that's going to wrap up this video. Again, you know, keep those comments coming. I do appreciate it, because, you know, it's one of it's comments like that you made, Kusun, that helps traders understand the markets, that there's more than one way to look at a market. And again, I see comments, you know, someone commented on, you know, I'm struggling trading. People told me I have to look at this type of chart. Well, that type of, you know, like, I don't know I forgot what it was, 5-range NQ chart. And if you're new to trading, looking at a 5-range NQ chart is very difficult for a lot of traders, especially a new trader, because it's moving very fast, right? If you don't understand that it's moving very fast, it's going to be difficult to trade. You know, you're going to find yourself getting into moves late, buying a high and selling it at the low, right? Because you got in late, because you don't understand that a 5-range chart on NQ is a very fast moving chart. So that's why I appreciate these comments. You know, even though this wasn't necessarily an order flow related video, I thought it was a very important topic for traders to understand and, you know, sort of wrap their heads around. So again, thanks everyone for being a part of my community, listening to my my comments and my rants sometimes. If you enjoyed this video, be sure to hit the like button and subscribe to my channel so you don't miss any more of my upcoming videos. And again, keep those comments flowing. You know, I'm trying to be more proactive on actually making videos about the comments, because, you know, these are very valid points that need to be addressed by traders, because, you know, a lot of videos will just say, hey, you know, this is the way you're supposed to trade. Do this, do that. It's not about that. Trading is a thinking game. I want you to think as well. So, all right, everyone. I'll catch you guys on the next video. Bye-bye.